Respected all the members of Nagar CP Study Circle, I welcome to the first after AGM this meeting where our core group member CA Piyush Chhajed will be speaking on the topic, and I request our deputy convener Sri Jayesh Thakkarji to just introduce the speaker.
For giving me this wonderful opportunity. At the outset, I would congratulate you and the deputy convener for guiding for the next year, and also congratulate Seema for giving a wonderful year back. With this, to my current task, we have with us eminent speaker CA Piyush Chhajed, a senior partner in Chhajed and Doshi, specializing in appellate proceeding and arbitration matters. He was on various committees of WRC, ICAI, CTC, etc. from time to time. He is on external advisory committee of RBI for asset reconstruction companies 2019 onwards. He is contributor to various articles and books. The most latest is WRC publication on Vivad Se Viswas scheme 2020. He is on the board of various companies and trust with trust. With this, I welcome CA Piyush Chhajed and request to present his views and analysis on Finance Act 2021. Thank you.
Thank you very much, Manish Bhai, for the introduction. To the audience, I am audible, Simaji?
Yes, you are audible, sir.
Yes. The convener, Shri Krishna ji, deputy convener, Jayesh Bhai, immediate past convener, Seema Mehta, and the seniors of the core committee, past conveners, I can see many of them, esteemed members of the Nagar Study Circle. It's my real pleasure to be addressing the first meeting of this financial year, which has been after the AGM. It's the very first meeting, and being part of the core group committee and being part of this study circle since long. It is really my pleasure. I thank the immediate convener, past convener, and the convener and the deputy convener for giving me this opportunity to become the first speaker for this first study circle in the WIRC. And it's one of the best study circles, as always it has been. So I thank you very much. The topic for the day is Finance Act 2021. So I'll try to cover up that analysis. It's an important subject today because everybody knows that the President has just given an assent on 28th March 2021. It becomes a very important today because it gets applicable immediately. And if we analyze the Finance Act, a lot of provisions are actually applicable from assessment year 21-22. So it actually affects the financial year 2021, which really does not happen in all the Finance Act, but this time it's quite a bit. So it's a very right time, obviously. I do know that most of our members would be also now at the time busy with the bank audit because the bank audit is a busy season. But at the same time, because the Finance Act 2021 has come in force and most of members are always practicing on a direct tax, obviously they would be inclined to know. So I have tried to make my presentation. I'll just share the presentation on that. So Finance Act 2021, if I go to the history, everybody knows that Finance Act first initially a budget was presented and the finance bill was presented by the Honorable Finance Minister on 1st February 2021 to give the effect of the proposals, which would be affected for financial year 21-22. So budget is a regular exercise which generally all the professionals look forward to it. Look forward to it. What would be the changes in the taxation, indirect taxation, and the other policy matters of the government? How does the government look at it? How does the government what would be the government's projects for the next future year? It affects the businesses. It affects the professionals equally. And the budget has been always a very talked about subject for the professionals. People in the month of February and March, people keep on listening to the budgets, reading budgets, understanding those and actually implementing. Because in the future, the way how the businesses will be done, the way how the taxes will impact their businesses becomes very important. And we as a chartered accountant are looked forward to advise our clients based on the budget provisions. On 23rd of March 2021, the lower house, that is Lok Sabha, actually passed the finance bill, and after that it became a Finance Act 2021. Between Finance Bill and Finance Act 2021, there were a lot of amendments were made, a lot of new sections were inserted, and ultimately it was passed. The Finance Act do not come into the force till the time President gives assent to it. Ultimately, this Act bill was given an assent on 28 March 2021, and Finance Act 2021 came into force. So from 28th March 2021, the Finance Act 2021 is in force, and the provisions of those Act will be applicable from that particular date. Generally, the Finance Act 2021 applies for the assessment year 22-23, unless and until it is mentioned very specifically. In this Finance Act 2021, which I've seen, the majority, most of the provisions are applicable from assessment year 21-22, that is financial year 2021. Though this may sound as if it's a retrospect, it is a retrospective, and there are certain issues, there are certain provisions which have been made applicable from assessment year 21-22. And this act has come into force on 28 March 2021. So question may arise that already 363 days are over and the businessmen have done the transactions in a particular manner. And now this Finance Act 2021 provisions will be applicable to those transactions which have been already done when the act was not in force, or even the bill was not presented, so certain transactions. So these issues may remain. We may have to look into it, and we may have to seek a lot of clarifications on this, and we may have to take up positions on various issues when this arises. During this last year, there were a lot of amendments which were coming in the Finance Act. As you all know, if you go behind the way direct taxes have changed, direct tax practice from a professional's point of view has become more faceless. The scrutiny proceedings are completely faceless. CIT appeals have become a faceless. You don't know who is your assessing officer. You don't know who is your CIT appeal to whom you would be presenting your case. There is no provision as of today that whether the personal hearing will be granted by the CIT appeal. Everything would be faceless. You respond on the written submissions. So there was a lot of changes which was happening, and it was becoming a faceless. So a thought process was coming to my mind that if everything becomes a faceless, I'm sure a lot of litigation should go down. A lot of appellate proceedings should go down. Assessment proceedings should become more smoother, because there would not be much more interaction between the assessing officer and the assessee. And that may result into a better assessment possibly, or even if not better assessment, at least the reduction in the harassment. Obviously, the experience of the faceless assessment has been seen. There are two types of divergent views are coming. Some people are saying that the assessment orders have been made without understanding the written submissions. Some people are saying that the assessment orders are coming clean. Even my personal experiences are there that both ways the orders are coming. Somewhere the orders have been passed without application of mine. Somewhere orders have been passed in a very simple manner, in a page or two, without going into the deep of what was verified, what was sought, what was done. So with this background in the mind, I was under an impression that obviously the tax practice, direct tax practice, the way which we were saying, as far as the representation is concerned before the assessment authority or the appeal may go down to certain extent. But after the Finance Bill and the Finance Act 2021 has come in, I believe my thought process, or the thought process which was in the various professionals' mind, is going to change. Because there are a lot of changes which have been made, and there is a lot of confusions which is going to happen. And I'm sure that there would be another round of litigations which may be coming in. Just to make a very brief, before I go to individual section-wise presentation, there is a change in the total procedures of the reopening assessments. There is a change as far as the time limits are concerned for the scrutiny assessments, issuance of scrutiny notices, then filing of the returns. So there is a change. Obviously, I've been told the objective behind these changes are at one place it is to businessmen should have a clarity, should have a certainty when they are doing the transactions. Now it's in today's time, it's happening that your assessments are opening for 2 to 3 years period. Then there is a reopening from 4 to 6 years. And therefore the certainty in the transactions which have been already done by the businessmen has not been achieved. So to have a certainty and to reduce the period whereby uncertainty remains, I believe these changes have been made. But there is a lot of changes I've also made in other reopening assessment proceedings. And my experience in last 3 days after the Finance Act has been passed, that is after 28 March to 31st March, there is a dearth of reopening notices been coming in. Now reopening notices are coming in. So what would be the procedure? The questions may arise. And first, there may be a lot of litigations in this area, which I look at it. So I would start with my presentations on the budget. So if on the Finance Act, if you see, I've divided my presentations and I'm starting based on the important provisions. There are 4 to 5 main important provisions which have been either substituted or have been amended or have been new sections have been inserted, which needs to be looked into in very detail. That will have an impact on the existing businesses. It may have an impact on the future businesses. Then there are small other amendments which I will try to cover up. So I've covered into 3 or 4 portions, typical detailed analysis I've tried to do in respect of certain provisions, which requires a lot of deliberations at the professional levels. There are a lot of gray issues which are involved in this particular provisions. And then there are certain provisions which are very straightforward, simple, more in the procedural requirements, so which I will try to take it faster. So coming to the very important provision, important amendment which has been made in this Finance Act 2021, which was also finding place in the bill, and then there is certain amendments made when compared to a bill and the act. This is the Goodwill Provisions. What is Goodwill? As we know, we should go into the history. What is the existing provisions for the Goodwill? How the Goodwill is generated? As you all will be aware, whenever there is a merger or amalgamation that takes place between the two entities, between the two private limited companies, if there is a merger or amalgamations in accordance with the Companies Act, there is an accounting standard which deals with the accounting of this amalgamations, which is AS 14 issued by our ICI and also recognized by the Companies Act and Companies Rules. What does that AS 14 amalgamation says? That any amount paid at the time of the amalgamations, any amount paid at the time of amalgamation, which is over and above the book values or over and above the intrinsic value or the net worth of that particular company, should be recognized as the goodwill. So at the time of mergers and amalgamations, the amounts paid over and above the net worth or over and above the book values was being recognized as a goodwill in accordance with AS 14. Other than mergers and amalgamations, there were transactions which were known as slump sales. In a particular slump sales, in a merger, generally the one company gets merged into another, and the company which is a transferable company is not in existence. Whereas as far as slump sale is concerned, it is as good as business takeover agreements happens, wherein only a particular unit is taken over by the buyer at a lump sum consideration. So the person who is transferring its particular unit continues its operations, maybe of the other units, or maybe only a company may remain or the firm may remain who is selling. So even in the sum sale, what was happening as a matter, what assessee used to do is whatever amount was paid over and above the net worth, they were recognizing that differential amount as a goodwill in the books of accounts. The question arose over a period of time. Let's take an example that I'm paying but if I'm taking a particular assets either by way of mergers, amalgamations, or subscripts, and the block of the assets, the value of the assets is say 80 rupees, and what would happen 100 rupees, and I'm paying for that particular assets 200 rupees. So how should I recognize this 100 rupees? An issue was there. So in accordance with AS 14, and also for the purpose of the sum sale, where the AS 14 do not apply, the assessee used to recognize those excess amount paid as a goodwill. A debate arose whether this goodwill, which is recognized in the books of accounts, should be allowed as a depreciation or not. As we know, there is a definition of intangible assets. There is a block of assets. Then there is a explanation to 32.1.2, which says what would be an intangible assets. So intangible assets included a lot of trademarks, know-how, and any other commercial rights which are of similar nature. So goodwill was not specifically mentioned. So there were disputes going on that whether the depreciation should be allowed on goodwill, considering as an intangible assets. After a lot of disputes, ultimately this was settled by the Honorable Supreme Court in case of Smith Securities that goodwill is a depreciable asset. It would be an intangible asset, and the depreciation shall be allowed under Section 32. The prescribed rate of depreciation was 25%. So it was quite substantial. In case of takeovers, mergers, where the price which is paid above the book value generally ranges, which is almost double because the valuation is either on the DCF basis or a EBITDA multiple basis, wherein the valuation is quite high when compared to the value of the tangible assets which are taken over. The value of intangible assets, if you see in the last 10 to 15 years, value of tangible assets is not derived much at the time of the sale, merger, amalgamation, whereas value of intangible assets is more. So, in accordance with the law as required by the Act, it was been calculated and booked as a goodwill, and a depreciation was being claimed by various bodies. The question that arose in the mind that whether this goodwill will be allowed as a depreciation. Unfortunately, if you see, there is the way the which depreciation has been calculated. People have been calculating depreciation around 4 to 5 years, though it's on a WDV basis, because but the depreciation knows as 25%. The person who was acquiring the company or acquiring the asset on this sunset used to get a substantial tax benefit. And this tax benefit, I don't know, the government felt that the goodwill should not be allowed as a depreciable asset. They wanted to practically reverse the provisions or the law laid down by the Honorable Supreme Court, and therefore they came with that amendment. Now the amendment is the basic intention or the basic objective is that a depreciation should not be allowed on the goodwill. So therefore an amendment has been made, consequential amendment in the definition section of block of assets, where the block of assets, from the block of assets, a block of intangible assets, goodwill has been excluded. Similar amendment has been made in the explanation of 32.1.2, which explains the meaning of intangible asset for the purpose of claiming depreciation. From them also the goodwill has been removed. Then there is also change in the provisions of calculations of WDV in the 43.6, 50(2), when there is a sale of a particular asset. And then also the cost to be arrived for the purpose of Section 55, when ultimately the goodwill has been sold. So there has been an amendment been made stating that goodwill will not be allowed for the purpose of depreciation. Goodwill is not to be considered an intangible asset. Now the question that arises, if anybody reads 32 provisions of 32.1.2 intangible assets, goodwill was never mentioned in this particular section. It never said that the intangible assets includes goodwill. It always says that there are specific mentions, that is trademark, know-how, and any other commercial rights of similar nature. So there was an open definition which spoke of commercial rights of similar nature. Now the courts have interpreted that this commercial rights of the similar nature should include goodwill also. There is nothing called separate goodwill, but goodwill is a bucket of various other commercial rights, and therefore the goodwill is only a matter of convenience, whereby the SSC in his books of accounts is actually recording a goodwill. But goodwill does not really, the amount which is recorded as goodwill really does not only pertains to goodwill. There may be many more other commercial rights into it. So there are various judgments to that extent, that which says that the goodwill includes various other commercial rights. And goodwill is a bucket of the various such other commercial rights for a matter of a convenience or required by the statute under AS 14. This has been recorded as goodwill, but technically whether this is a goodwill. So SSC may argue even today, when there such transaction happens, let's take an example. If I'm buying an 100 rupees asset, the value of the asset or the intrinsic value is 100 rupees only for a value of 200 rupees, whether this 100 rupees is, whether I can apportion it in the books of acquirer, which hitherto I was recognizing as a goodwill, whether I can recognize or break up that 100 rupees under the various heads. Can I say just that it's a commercial right? In my view, obviously, SSC can say these are the commercial rights, because I would just like to, at this stage, take your to the judgment rendered by Delhi High Court. If you can see on the screen, that are the judgment rendered by Delhi High Court in Hindustan Coca-Cola Beverages and Areva T&D India. What does the ratio of the judgment says? The ratio of the judgment is the goodwill is a bucket of the various other commercial rights, which includes trade style and name, marketing and distribution rights, territorial know-how, information consumption patterns, habits, copyrights, trademark, patents, trade secrets, and so on and so forth. Employees, if anybody has to start a factory today, obviously for creating a skilled employees for that particular factory may take 3 to 4 years. And that is why the business acquisition takes place, because you get a ready-made employees who are trained on a particular manufacturing activity. So when the person who is acquiring, he also look into it, that important skill employees availability with that particular factory. He also look into the customer rights, customer assignments. He looks into the various vendor contracts. He looks into it, various customer contracts, various lease contracts. So all those contracts have been valued, though they may not be separately valued and they may be booked as a goodwill, but technically those all are still will be covered under the commercial rights of similar nature in my view. And that has been the view taken by the Delhi High Court in both of these judgments. And they have listed, if I have to compare both these judgments and add up the listing which has been done, this all would be coming in it. It's a business claims, business records. All those actually get some value to it. Now the question arises, after the amendment has been made, if there is an acquisition transactions, how should I recognize this excess amount of rupees 100 paid towards the value of the various records? How can I divide this 100 rupees into many? Whether I should also recognize certain amounts towards goodwill and do not take a depreciation, and on the balance with commercial rights, I should recognize certain amounts. How should I do it? This may lead into a litigations. Obviously, as an assessee, as a professional, I would advise that this 100 rupees obviously is pertaining to the bucket of various commercial rights. Now the question arises, out of this commercial rights, how much is to be allocated to goodwill and how much has to be allocated to other commercial rights excluding goodwill? So if out of 100 rupees, I am only allocating 10 rupees to goodwill, balance 90 rupees can still be capitalized as an intangible asset and the depreciation can be claimed. Obviously, this may lead to a litigations because hitherto previously nobody was doing that. Everybody was capitalizing as a matter of convenience in the goodwill. Just to overcome the amendment which made, the question may arise, assessing officer may raise an issue that this is nothing but an goodwill. Only to get a tax benefit out of it, it has been divided into it. So it may lead to a litigation. But the view remains that, in my view, it remains that yes, the amounts can be appropriated amongst the various other commercial rights and they can be capitalized under the intangible assets. The question may arise, what heading you would use? The auditor will have to look into it, books of accounts will have to look into it. Of course, as far as amalgamations are concerned, where AS 14 is applicable, you may have to still continue to debit it to a goodwill account and disclose it as a goodwill in the books of accounts. But for the purpose of your tax returns, you can have a valuation done. You can have an individual commercial rights valued. A valuation can be done, and based on that valuations in your block of assets, you can include certain portion in intangible assets, claim 25% depreciation, and the amount which is allocated to goodwill as per the said valuation reports may not be included in that, and the depreciation may not be claimed on that. So this may still continue on that. Now there is another amendment which has been made for just as you know, there are already there in particular case, particular clients, particular assessees, there would be already a block of assets of intangible assets, which contains various intangible assets. So there may be a software, there may be a technology, there may be a know-how, there may be a goodwill included to it. In block of assets, there are various judgments earlier also, including that of Bombay High Court, which states that once an asset actually enters into a block of asset, it loses its individual identity. So the draftsman of this law knew that there is a judgment which says once a goodwill has been included, now there is a block which is said intangible assets. You cannot disassociate out of those intangible assets, which includes 8 or 10 types of intangible assets, or maybe 2 or 3 types of intangible asset, a goodwill from it. Because the goodwill has lost its identity when it comes to a concept of a block of asset. Block of asset actually goes into a header. It says it's an intangible asset. Once goodwill enters into it, it loses it. So there may be a scenario wherein as on 1st April 20, you have a block of intangible assets, which includes a software, which includes a trademark, which includes a know-how, which includes a goodwill. So the provision has been given, there is a provision added to section 50 bracket 2, which says that as on 31st March 20, if that particular intangible assets includes a goodwill on which depreciation has been claimed prior to 31st March 22 in the previous assessment years, then you need to rework those depreciation, rework how much depreciation has been claimed. You have to arrive at the WDV individually of the goodwill, and that amount of the goodwill, that depreciated goodwill, needs to be taken out. For the convenience sake, I have given one particular example without going into it. Of course, the members can look into those examples. So what does it say? If you see in effect is, what is my goodwill by opening WDV is 82 and adjustment on account of goodwill is 56. In short, what does this example does is, whatever, if my original book value of goodwill was 100 and after claiming depreciation, my WDV of goodwill in block of assets is 56.25. That is, then I should reduce that 56.25 from the opening WDV block of intangible assets. That in short, there cannot be any further claim of depreciation on this intangible assets. Of course, this also reverses this amendment of 52 also actually reverses the various judgments which are in place, existing judgments, which always say that even if one particular asset goes into a block, and if the depreciation is not allowable or it is not put to use, or you don't remain the owner of the asset, still the depreciation will be allowed on a block. It is not necessary that all the particular assets in that particular block should be used by the assessee for a year. The user test has to be checked only the year of one where the acquisition takes place. But obviously, the intention of the government is very clear that they should not permit any depreciation on the goodwill. Now, the question here arises, as we have discussed earlier, that this goodwill which I have capitalized under the intangible asset was a bouquet of various services, various commercial rights. Only as a matter of a statute or as a matter of a convenience, I had capitalized this as a books in the books as well as in my computation or in my block of asset as a goodwill. So the question may arise for the opening balances also, whether this 56.25, which is the WDV of the goodwill, should be bifurcated into the commercial rights. Can I do that today? That the goodwill in this 56.25 is only pertains to 10. And not whole 56. 46 is in respect of other business or other commercial rights, which we have seen, which have been laid down by the various judgments of Delhi High Court. So whether we can do, in my view, yes, it could be done, because what has been restricted is purely goodwill, not other commercial rights. So if by proper valuations, at the time when this goodwill was acquired, when this goodwill was recorded, if you have an agreement in place, and if a proper valuation could have been done, that goodwill actually comprised of various commercial rights, and there can be an amount allocation to different commercial rights. Obviously, then the reduction from the WDV should not be of the complete amount, but only to the amount which is allocable to the goodwill and the depreciation thereon claimed up till 31st March 20. Now, once the goodwill does not remain a depreciable asset, obviously goodwill will become a capital asset on which the depreciation has been not claimed. So if I sell this particular goodwill, the unit which I have acquired, tomorrow I am going to sell also this particular unit. And if I sell, then how would be the capital asset, capital gains would be taxable. Obviously, goodwill will be now taxable as a capital gains, as a capital asset, for the purpose of which, how the cost has to be calculated. Obviously, the cost has to be calculated is your cost of acquisition, actually at the price which you have paid, less depreciation which have been claimed. So the amendment which has been made is the cost of acquisition is a purchase price under section 48. That is the amount which you had paid for acquiring the goodwill. And if the depreciation has been allowed up to 31st March 20, because the depreciation has been already claimed, the value of that depreciation which has been already claimed should be reduced from the purchase price. So in effect, a WDV of goodwill as on 31st March 20 would be treated as a cost for the purpose of section 48, for the purpose of calculating capital gains when ultimately this goodwill has been sold. So just to summarize the key points in respect of the goodwill is, now goodwill is, it's ineligible for depreciation, both for existing goodwill, which is in the part of the block, as well as the new goodwill, which will be acquired after 1st April 20. As I have very well, I again clarify, goodwill is only a goodwill. How much you can allocate to a goodwill is a different thing. A goodwill, as per the dictionary meaning, also may include various other commercial rights on which still the depreciation will continue. So assessee, a businessman can be advised or can take into a valuation wherein the lump sum amount which was hitherto been debited to goodwill can be broken up into the various other commercial rights, and you may continue. Number 2, cost of acquisition of self-generated goodwill be nil. So if the cost of acquisition of the self-generated goodwill, so if it's a professional firm today, let's take a chartered accountant firm. In this case, the goodwill has been self-generated. I have not acquired a goodwill of any particular company. It's a self-generated. And if ultimately I'm selling that particular goodwill, then the cost of acquisition should be nil. Now the question may arise, if the cost of the acquisition of the goodwill is nil, then whether on selling that particular goodwill, whether there would be any capital gains tax liability. There is a judgment, whole judgment of BC Srinivasan, which says if the cost of acquisition is nil, then the calculation mechanism of the capital gains fails, and therefore there cannot be any capital gains. I believe that particular ratio should also hold valid today also. And therefore, in case of cost self-generated goodwill, if it is acquired or sold at that time, one can argue that there is no tax liability. But in case the goodwill was acquired prior by way of acquisition of some other entity or unit, in case of business entities, which generally happen, and it is sold later on, then there would be a capital gains working under considering the provisions of Section 55. Third is adjusting closing WDV of intangible assets, for which we have already discussed. So this is the basic points at the goodwill. Obviously, I believe as far as goodwill is concerned, the litigations will remain. Obviously, the major entities, major companies where this amount runs into billions of monies, crores of monies, and lakhs of monies also would like to take still benefit. If they are not taking the tax benefit which they have already paid to the seller of the particular units or the particular company, obviously your cost of investment goes up. If you get a tax benefit, your cost of investment goes up, ROI changes, and a lot of people, your mergers, acquisitions, slump sales may undergo change in case they are not been able to showcase that the amounts which are paid are towards commercial rights and the depreciation is allowable. And therefore, you may have to readjust, relook into your BTS, business transfer agreements, relook into it, acquisition agreements, propose acquisition agreements. Coming to another important amendment which has taken place is the slum sale provision, Section 50B. Section 50B is in regard to the slum sale. What does the existing slum sale provision says? That if a particular assessee is selling a unit per se as a whole, let's take an effect. I am a company. I have a 2-3 separate units. I have a Vapi unit. I have a Baroda unit. I have a Mumbai unit, and I want to sell the Vapi unit along with all its assets, all its debtors, creditors, all its assets and liabilities in short. And if I sell it for a lump sum consideration, it would be treated as a slum sale, and taxability arises under Section 50 capital B, wherein it is treated as a long-term capital asset, and the capital gains is calculated currently. Whatever the value, whatever is the transaction value for selling that particular unit is treated as a full value of consideration. And from that, the cost of acquisition is equivalent to net worth. So whatever assets less liabilities have been taken over or have been sold by way of slum sale would be treated as cost. The difference would be taxed as a capital gains. Now the question arose, as you know, whatever over and above, as we have discussed earlier in the slum sale, whatever was paid over and above for the purpose of acquire, it was treated as goodwill, which we have discussed it. But for as far as the seller is concerned, it remains the capital gains, and the capital gains tax has been paid. Now there is an amendment been made in the slum sale, meaning of the slum sale, as per Section 2(42)(c). What was the initial amendment? This is the existing provision on the screen, which you can see. It says, as per 242(c), slum sale means the transfer of one or more undertakings as a result of the sale. So word important was as a result of the sale. So there has to be transfer of the undertaking as a result of the sale. So if there is a transfer of undertaking, not as a result of the sale, it may be a result of something else, by other means, were not been covered, and there were judgments to that extent. And then there is a other condition for a lump sum consideration without values being assigned to individual assets and liabilities in such sales. So this was the existing provisions. There were divergent views on the slump exchange. What was happening in, let's take an example, that I am selling one particular unit to somebody and another person is giving me an unit in lieu of that. So there is an exchange of unit, or instead of money coming into it, there will be shares coming to me. Instead of, when I'm selling a unit, the person, the acquirer, is actually issuing me the shares. So the courts have laid down that because there was a transfer of undertaking for a consideration other than money, that does not falls under 242C, and therefore there wouldn't be any tax liability under the section 50 capital B. So in case the transaction was for a consideration other than money, it's an exchange, it's a barter sort of, or certain shares are being issued, 242, it does not falls under 242C. So there were the divergent views which had been taken by the various courts on this account. To overcome this, the amendment has been made. Wherein says 242C now reads, if you see, transfer of undertaking as a result of the sale, which is the initial portion, which is the current position. Now the amended would read to transfer of undertaking by any means. So there may not be a sale. There may not be a sale agreement per se. There may be a restructuring agreement. There may be a consideration which is not coming in the money. So all types of transfers are included within those by any means. Now some sale by way of such exchanges will also be covered, and now paying cash consideration is not necessary. So if you actually look into the amendment, both two important amendments, which in the definition section, the word sale has been technically replaced by any means, will have an effect that all exchanges where the consideration has been paid by way of in kind or by way of issue of the shares, those will be covered. So these two important considerations that the amount should come in the cash is not required today. So it would be taxable. Another amendment has been made in section 50 capital B, wherein it says now initially for the purpose of the slum sale, the consideration was to be treated as the amount paid, full value of the consideration. So the value of the consideration as per the agreement between the buyer and the seller was treated as full value of the consideration. Now, in line with various other provisions, wherever the immovable properties or wherever the shares are being transferred, the income tax knows that the book value may be very less and the value of the consideration may sometimes do not show the fair market value. And therefore, at various places, the amounts have been, the consideration value, transaction value has been replaced by the fair market value. Now, the similar amendment has been made by this Finance Act, thus in the section 50 capital B, wherein it says fair market value of capital asset instead of book value shall be considered. So if initially when we were just reducing a net worth, whatever is the net worth was also included the book value of that particular asset. But when the sale consideration was the purely a transaction value. Now the transaction value would be replaced by the fair market value. So the fair market value of the capital asset, if it's an immovable property, obviously I believe there would be a certain, of course, the power has been taken in the Finance Act that how the fair market value would be calculated, but that has not been yet prescribed. 11U, 11UA are already there for calculating of fair market value in case of the immovable properties sale, in case where the shares are transferred. So there is already a certain provisions, but those provisions as of today were not applicable to slum sale because a whole unit was being sold. So the provisions of section 11U or UA were not applicable in my view. But now, because there is a specific prescription that FMB, I believe that the rules may be prescribed, which may or may not be similar to 11U or UA. I think so the rules should come during this year. Now, new clause in explanation 2 of section 50. Again, there's another new clause. Value of capital asset with goodwill, which has not been acquired by the assessee by purchase from which shall be taken as nil by computing net worth. So, if the similar provision which we saw when we were discussing on the goodwill, even for the purpose of this lump sum, when I'm calculating a net worth, value of the capital asset, if their value includes, it's a self-generated goodwill. So somebody would, what would they? He may recognize a goodwill and create a reserve to that extent, or a revaluation reserve. So that when I'm calculating these lumps, long-term capital gains, and I want to calculate the net worth, such self-generated goodwill should be excluded. In short, the value of the self-generated goodwill will be taken as well. The value of the goodwill will only be taken if that goodwill was generated or was been acquired by the payment of the consideration to some previous owner of that particular goodwill. In such case, that amount will also form part of the net worth, and the calculation of that particular asset will take place. So these are the so if the implications, if you see on account of the change on this lump sum list, the final implications, if the transferor receives any amount which is greater than fair market value, in the hands of seller, there is nothing, because even today, the seller, if the fair market value is 100 rupees, and if he receives 110, he has to pay capital gains tax on it. What happens in the buyer? Buyer will have to look into it, that how the excess consideration will be recognized in the books of his accounts, whether it will be recognized as a goodwill or other commercial rights of similar nature. So buyer will have to look into all these considerations, keeping in the mind amendments made in regard to the goodwill and the amendments made in regard to this lump sum, because the depreciation of the goodwill may not be that, but the goodwill will still be treated as a capital asset, and capital gain shall arise on its subsequent transfer. In case the actual transaction value is less than fair market value, what happens in the hands of seller? As of today, if you are selling that particular asset by less than fair market value, still for the purpose of the capital gains, you were only considering the actual sale consideration, the transfer price, the agreement value. You were not supposed to consider fair market value. So in case of the seller, now the liability to the capital gains tax would increase due to the dimming faction, which says for the purpose of this, the actual consideration would not be looked into it, but the fair market value would be looked into it. As far as in hands of buyers is concerned, short consideration is paid. So let's take an example. My fair market value is 100 rupees, but if I'm paying 90 rupees only, what will happen to them? Can I actually book it as a capital reserve because I've got it at a discount, or I should actually reduce it from the goodwill to per se? Or if I'm paying even below the net worth at loss, if I'm buying an asset, then what will happen? Let's take an example. My net worth is 100 rupees and I'm buying it. The fair market value is only, I'm buying it at less than fair market value at 80 rupees. 80 rupees, and the fair market value is 110. So seller is paying capital gains on 110. I am paying only 80 rupees for a net worth or intrinsic value of 100 rupees. So whether this 20 will go as a capital reserve in my case, which will not be taxable, but at the same time, I can recognize all the assets acquired by way of slum sale at the book value of 100 rupees and claim a depreciation thereon. The another very important and big amendment which has taken place is in section 45(4), dissolution or reconstitution of partnership firm. So there is a lot of changes which has happened in this particular case. As we know, there is a section 45(4) already there, and now it has been amended. Initially, if you see the bill, there was an amendment made. Section 45(4) was amended, substituted, and also another subclause 4A was inserted. But that 4A, you will not find a provision in the Act, though it was in the bill. But a new section has been inserted in the Act, which is section 9B. Obviously, 45 deals with the transactions transfer of a capital asset, and 4A was not a bill to cover those things. And therefore, 4A has been done away with as proposed in the bill. But section 9B has covered to also bring in certain transfers or receipts of stock in trade. Not a transfer, but a receipt of stock in trade at the time of reconstitution or dissolutions. So to understand what does the 45(4) amendments really result into, I have tried to list it down. What are the existing provisions of 45(4) and what is the amendment provisions? The heading of the 45(4) amendment is taxation on receipt of capital asset or money by a partner. So if any particular partner receives any capital asset or a money from a firm, then section 45(4) would be invoked. What was the existing provisions? The existing provisions dealt with transfer of a capital assets at the time of dissolution or otherwise. So if you read dissolution or otherwise, capital gains tax in the hands of firm only in case of transfer of capital asset. There was a word transfer of a capital asset. The amended provisions does not talk of transfer anywhere. It talks about receipt of money or capital asset. So money is the added, number one, money is added, and the word transfer has been replaced by the receipt in the section 45(4). If you see the new old provision that the substituted provisions. Further, the 45(4) talked about dissolution or otherwise, whereas the amended provisions only now talks about the reconstitution. No dissolution is covered, but dissolution is now covered by section 9B. So the basic amendment is the change is receipt, so there's no need of transfer. This has come because there was a judgment of the Supreme Court, wherein it has been held that under Indian Partnership Act, firm and the partners are not different. So there cannot be any transfer of an asset between a firm and partner. It laid down a ratio that the partnership is nothing but as good as individual persons coming together, and the individual rights remains over the particular assets. So even if the firm gets dissolved, there was no transfer, basically. And therefore, to overcome that, the section has been amended to say that any receipt of money or capital asset by a partner, the section 45(4) would be invoked. So let's take an example. If at the time of reconstitution, if one particular partner is going out, is retiring from the partnership firm, and he is receiving some money out of it, or he is receiving instead of money some capital asset to it, then section 45(4) would be invoked, and he will have to pay the capital gains tax. Firm will have to pay the capital gains tax by doing a calculation there. There is a calculation which I will come to further. Then the second amendment is the second existing said no taxation the word otherwise was been if the words of the 45(4) was dissolution or otherwise. Now this otherwise was interpreted by various courts that it does not include reconstitution or retirement of partner. So at the time of retirement of partner, no taxation of capital gains arose. We have seen the cases when if the partner's capital account contained 100 rupees, 50 rupees for two partners, and the asset was revalued at 200 rupees, and the 100 revaluation reserve was credited to a partner's capital account. The retiring partner used to withdraw the original capital as well as revalued capital, and the new partner used to bring in. So there was no tax liability because there was no transfer. So there was a judgment to that extent, including that of Bombay High Court. And therefore, to cover up this particular transactions also, the 45(4) has been amended. As far as distribution of money was not covered earlier also, and therefore also it was not being taxed under 45(4), because instead of my capital balance of 50, after revaluation I was receiving 100 and money was not covered under 45(4). There were the judgments. So the existing provisions had very limitations. The limitations on account of transfer. There should be a transfer of capital assets. In case of firm and partner, there is no transfer. In case of retirement or reconstitutions where monies were taken, it was not covered by the money, and therefore it was not taxed. To cover up this particular lacunas or particular loopholes or particular whatever benefits the assessee were taking, the amended provisions have come. Wherein 45(4) has been amended, completely substituted, not amended, it would be substituted, which now onwards says that if any partner receives any money or capital asset by a partner representing his capital account balance on reconstitution, so it would be taxable. How it would be taxable? Capital gains tax will be chargeable in hands of firm on receipt of money or his capital asset by a partner in excess of his capital account balance. For the purpose of this, value of money and a fair market value in case of capital asset will be deemed to be the full value of consideration, and capital account balance of partner will be deemed to be cost of acquisition. So so under 45(4), now the calculation of the capital gains would be as under value of the money received. So what is the value of actual money received? So what is the amount I received at the time of retirement plus I will add the value of the asset which is received, fair market value of asset. So obviously the fair market value of the capital asset, if it's an immovable property, would be the value of the government value, I think so. Too. So those both will be added and will be treated as the total consideration received. Out of that, whatever is the balance in your capital account, without giving effect to revaluation of assets, self-generated goodwill, or any other self-generated assets. So whatever is your original balance in capital account will only be reduced. And therefore, there will be a capital gains liability in the hands of firm. If the value of the money and the asset received is less than the original capital which was invested by a particular partner, it would be a negative figure. There won't be any capital gains tax. So the 45(4) covers all the transactions. Now, even the receipt of money or capital asset by a partner would be taxed. There is no requirement of transfer. So the judgment which was earlier on taxability, if you see, there's no tax before Section 9B came in place. What was the position? 9B and 45(4). It has to be read in conjoint. Both will operate mutually exclusive. But if you read in conjoint, there was no taxability on distribution, division, or allotment of assets by a partnership firm upon dissolution or reconstitution. There's nothing but a mutual adjustment of right between the parties. These are the ratios laid down by Apex Code as in 1979. So because the basic ratio under the was that it is not a distinct legal entity apart from the partners concept. So overcome these ratios and to overcome the values of the monies which have been transferred to the retiring partners, this provision has been amended. But what I could see now, a new section has been brought in by Section 9B, that is inserted after Section 9 capital A. Income on receipt of capital asset or stock in trade. Technically, what this provision tries to tax is the transfer of right by the partner, the outgoing partner, to maybe the incoming partner or maybe the continuing partners. So it's trying to tax the transfer of right by the outgoing partner. So there is a two-way transaction. What is happening? In 45(4), there is a transfer of capital asset or money from the firm to the partner, and therefore it is taxable. Whereas Section 9B actually envisaged transfer of rights or partnership rights from one particular outgoing partner to maybe the continuing partners, and therefore it tries to tax. Section 9B covers not only a capital asset, it also covers stock in trade by a partner from a firm on a reconstitution or dissolution. 45(4) applies only in case of reconstitution. Now, Section 9B applies also in the time of reconstitution or dissolution. Obviously, there would be a specific 48. There is an amendment made under Section 48, subclause 3, stating that there won't be a double taxation if the tax has been paid under 45(4) or it has been paid under 45(4). While calculating capital gains tax under Section 9B, you will get credit of it. So, what does the main intention of Section 9B, if you read this, there is an income on receipt of capital asset. There is an income on receipt of stock in trade or both. So if you receive a capital asset or stock in trade or both, there is an income received in the hands of the partners or the members from AOP, boy, from whatever. So the amounts by way of the amounts or the consideration received in kind by way of a capital asset or stock in trade received by the partners is taxable in the hands of, technically taxable in the hands of the partner, but the tax has to be borne by the firm. So it will be taxed in the hands of the firm as a capital gains or business income, depending upon as the case may be. If it's a capital asset, it will be taxed as a capital gains. If it's a stock in trade, it will be taxed as a business income in the hands of the firm. Amounts received, when it would be taxed? It would be taxed when it is received by the partners. So if it is received by the partners on 31st March 21, before 31st March 21, a particular capital asset or particular stock on the reconstitution or on the dissolution, the amounts would be taxed in the hands of the firm and they will have to pay capital gains or the business income depending upon the nature of the asset which has been received by the partner. Also, this section has defined section reconstitution. What does the reconstitution mean? Reconstitution includes one or more of its partners or members ceases to be a partner or a member. So it's a very simple, it's a retirement. If out of the existing 4 partners, any one or more of its partners retires and he ceases to be a partner or a member, it will amount to a reconstitution and the provision of Section 9B will be applicable similarly for effect. 2, one or more new partners or members are admitted. So if somebody has been admitted, then however, at least one existing partner or member should continue to be a partner or a member of specified entity. Specified entity means a firm, and specified person means the partner or the member as defined under the provisions. So members should continue to be a partner or a member of specified entity after admission of the new partner or member. So there has to be admission of the one partner. Another consideration is, for purpose of following it in the definition of Reconstitution, is that one or more partners should be admitted, and out of the existing partners, one member should at least continue, or one partner should at least continue. So if there are two partners and one has been admitted, and out of that two, none retires, or even if the one retires, partnership will continue. But in case both retire, then obviously if there is not a reconstitution, it becomes a dissolution. And hence, therefore, this condition is that at least one partner, existing partner, should continue and one should be admitted to fall under the reconstitution. Third, all the partners or members continue with change in their respective share or in share of some of them. So what happens is, I am a 4 partners who are equally 25% partners. Now, out of this, there is a change in the respective share. So out of these 4 partners, one partner wants to reduce his shares, possibly on the retirement or on the verge of retirement. He says that my share would be 10%. So out of 25%, his share has been reduced to 10%, and other 3 partners' shares are continue at 30, each 90%. So there is a change in the respective share. Now, this change in the respective share will also fall within the definition of the Reconstitution. Once it falls within the definition of the Reconstitution, Section 9B shall be applicable. So once a change in the Constitution takes place, change in the profit share takes place, Section 9B will be attracted. But for the purpose of application of Section 9B, there has to be receipt of capital asset or stock in trade. So the person who is retiring, if he's for the purpose of relinquishing his 15% share from 25 to 10, if he derives or if he receives any capital asset or he receives stock in trade in lieu of transfer of his partnership, right, then the Section 9B will apply. Just a lot of times it happens that amongst the family members, there are 4 partners and one partner retires and he does not take any money over and above the capital account balance. So then there is no application of 45(4) or there is no application of 9B. The application of 9B or 45(4) arise only on receipt of capital asset and receipt of stock in trade. Then 9B is applicable. And in case on receipt of capital asset or money, Section 45(4) is applicable. In case of capital asset, both sections are applicable with no double taxation provision available under 48(3) to summarize it. So if there is a change in the respective shares without any consideration being paid for reducing the transfer, for reducing the partnership, for transferring the partnership right, or for relinquishing the partnership right, then it won't be a tax implication, though it would fall within the definition of reconstitution. So it may be a reconstitution, but for the purpose of calculation of tax, there has to be an income by way of receipt of particular asset, stock in trade, or money to fall under 45(4). So simply just change in share, which has been done by day in, day out. We keep on looking in the family firms. According to me, none of these provisions will affect those. Income of receipt. How to compute the gains arising from deemed transfer of stock in trade. Transfer of stock in trade taxable in the hands of the firm as profits and gains of business. Fair market value of stock in trade is recorded as sale in firm books. What was happening is, I believe this has been very specifically brought in with the mind in the real estate industries. So in the real estate industry, a lot of joint venture agreements takes place between the landowner and the developer. They come together, either they enter for the purpose of development. So landowner brings the land, developer brings its construction expertise and also brings the construction cost. They structure that particular entity either as a AOP, it's a joint venture agreement, so it may be association of person, or they actually enter into make a new firm and bring those assets in new firm and do a business. After the business is over, there is a left in unsold units which happens. And because this is a specific special purpose vehicles only for a particular project, obviously both the partners of the firm or the members of the AOP would like to disassociate themselves and distribute the unsold stock amongst themselves. Now, at the time of distribution, either in the firm or AOP, there was a question that what would be the tax, whether there would be any tax impact, and what would be the value at what it would be taxed. Now, the Section 9B has also mentioned that stock in trade would be covered under Section 9B. So, at the time of the retirement, reconstitution, if somebody is going out individually and other continues the firm with other partners, or there is a dissolution, whatever stock in trade has been received by an outgoing particular partner would be taxable at the fair market value of the stock in trade. So, question, even for the inventory unsold units, you will have to take a fair market value. Otherwise, the question which was arising under 45.4 was, even at the time of dissolution when it was distributed, presuming that it would be taxable, though the 45.4 says there is no transfer in case of firms and AOP, but still presuming if it would have been taxed, it would have been taxed only at the consideration, actual value. There was no concept of fair market value in case of stock in trade. So Section 9B covers that. So now onwards, if any unit stock in trade is distributed, it would be taxable. Let's take an example other than the real estate industry, which may have an effect on many more other industries in today's time. If I am to think of, there is a bullion industry, jewelry industry, but they hold a huge stock of 50 to 100 crores. And those stocks in the books would be at the valued at maybe 25,000 per 10 grams or 30,000 per 10 grams because they were acquired when the gold prices were quite less at that moment of time. Now the gold prices has gone above at 50,000, 45,000 now, and it has gone up to 50,000. So value of stock in trade has gone up. At this moment of time, if any reconstitution happens and if any partners goes out taking his share of stock in trade, equivalent to his share in the partnership, right? Then the fair market value of that particular value of the gold or whatever other stock, gold or other precious stones, gold, diamond, silver, wherein the fair market value keeps on increasing, it's volatile. Also, the adjustment on account of the value of the fair market value of the stock would have to be done and the taxes would have to be paid. Coming to computation of capital gains arising from a transfer of capital assets. For calculating the capital gains under Section 9B, because it would be already suffering some tax under 45.4, there is a provision made under Section 48, subclause 3, that there would be a double tax. So for the purpose of this calculation, the formula would be full value of the consideration received or accrued. So either the full value of the consideration, that's a transaction value, or fair market value of the capital asset or the stock in trade, whatever the case may be, as may be. The stock in trade will not arise because in stock in trade 45.4 does not apply. So the deduction as claimed under the clause B will not be applicable. But if presuming it will be at fair market value, capital asset or stock in trade, whatever it is, less expenditure incurred wholly and exclusive in connection with transfer, cost of acquisition, cost of improvement, amount chargeable to tax as income of firm under 45.4, which is attributable to capital asset being transferred by the firm. So if any amount of tax has been already paid under Section 45.4, that is on a difference between the capital accounts balance, original capital account balance, and the fair market value of the capital asset, the tax which has been paid will be reduced while calculating the tax under Section 9B. So in effect, there is no double taxation. And if any exemptions under 54, 50 to the extent of net result of above calculation. So if any exemption has been paid. So in nutshell, now tax on transfer of money, it's actually not transfer. It should be read as receipt of money or property by a firm AOP to its partners or members. 45.4 deals, just to summarize, 45.4 deals taxability at that time of reconstitution of income arising on receipt of money or capital asset. 9B deals with taxability at time of dissolution or reconstitution of income arising on receipt of capital asset or stock in trade. So 45.4 and 9B, the only common thing is reconstitution at the time of reconstitution if there is a receipt of capital asset. This is a common for which 48 provides for that there won't be any double taxation and there will be an appropriate reduction allowed to the extent tax paid under 45.4. Whereas at the time of dissolution, only 9B will be applicable if the stock in trade is received or capital asset is received. At the time of receipt of money, at the time of reconstitution, only 45.4 will be applicable, no 9B will be applicable. So these are the three major amendments which have taken place. Before I go to the procedural amendments, which are also quite major and it's going to change the way in which the assessments is going to happen, reassessments are going to happen, search proceedings are going to happen. I thought it would be appropriate to cover other small amendments also. And what would be the effect? What would be the why those amendments are there? If you see all this up till now, what we have discussed in last hour, the major amendments have been made to overcome the position which has been set by the judicial bodies, the precedents. And this is, according to me, is not a good practice. After a lot of litigations, lot of deliberations, lot of amount spent by the assessors in litigating it, in a particular manner, a ratio was laid down by the apex courts, various high courts. And now after these amendments have been made, it has reversed those positions, and which may result into starting of the fresh litigations. It is always a law keeps on evolving. So if you're bringing in, if you're inserting, if you're substituting new sections, please bear in mind, law is evolving. It would be interpreted by the different authorities at different levels in a different manner. Even by the different professions, there may be a divergent views, which may lead to a lot of litigations. So generally, it is said that law should not be amended, law should not be tinkered with unless and until it is at most necessary. When those laws which are in place and which have been already been settled by the various litigations, it might be it should not have been changed. Now, the very big important amendment which has taken place is 36 subclause 1, subclause BA, 5A. The amendment this deals with the payment of employees' contribution to a fund on or before date. If you go into the history, the provisions of section 36(1) stated that the deduction for the employee's contribution will be available. So what is employee's contribution? If you are paying a salary, you are supposed to deduct PF contribution from the employee's salary and deposit it with the PF authority before the due date. If you do not deposit before the due date, this expenses was not allowable under 36(1)(5). Now, then there is another provision under section 43 capital B, which stated that any contribution to a particular fund, it didn't actually distinguish between the employee's contribution and employer's contribution. It only said employer's contribution, and the various is deposit if it's not deposited before the due date prescribed under the PF Act, but it is deposited before the due date of the return. 43B deals with the any delays but deposited before the due date of filing the income tax return, that particular expenditure should be allowed. So the question arises, a discussion arises, a litigation arises that 36(1)(5) is specifically for employees' contribution and 43B is only available to employers' contribution or both. So matter went into the litigation. So various high courts, including up to Supreme Court, along extortions and Bombay High Court and Big Pens, ruled that even the employee's contribution, which is recovered from the employee's salary and deposited, would be covered by 43B. Hence, if it is not deposited before due date prescribed under the PF Act, but it is deposited before filing of due date of return, it should be allowed. Because if you see in nutshell, if you are not depositing before the due date, that means it is a permanent loss. Even if it is deposited with the delay of 5 days or 7 days or 10 days, that expenditure will never be allowed. But the court had ruled it that because the 43B, if you read the section 43B, it says it starts with notwithstanding anything anywhere else contained in the act. So it was not withstanding anything. So once it was that, so it was interpreted that this will not be applicable. And it will be applicable to the only 36(1)(5) will not be applicable. 43B benefit would be available. So if the amounts are deposited before the 30th September, which is the due date for filing the return, or October, whatever may be, under 139(1), it would be allowed as an expenditure. In last 2 to 3 years, though the department is not accepting that positions, you would have seen that under 143(1) also, wherever you are reporting in the tax audit, that amounts have been paid after the due date prescribed under the particular law, but paid before the due date, the 143(1) adjustments are being made and those amounts are being disallowed. Even in 143(3) scrutiny proceedings, those amounts are being made, and a lot of appeals are pending. Now, to overcome this litigations or overcome this judgments which are in favor of the SSC, amendment has been made by way of putting an explanation. explanation says that there is the wording again, you get that the clarification is retrospective in nature. If you see, it says for the removal of the doubts, the employee's contribution was never included under 43B. And 3615A also talks that the provisions which applies to 43B will not be applicable to 3615A. So it says on removal of the doubts. Now the question is, in the prior, wherever there were the amendments were being made to, and it says for the removal of the doubts, the courts have held that it is a retrospective. It is not a prospective. Though the explanation has been done there, but it says for the removal of doubts, whenever there was a benefit which was available to the assessee, by the way, and either the budget speech or the explanatory memorandum or the wordings in the explanation very clearly specified for the removal of doubts, then it was held that it's a retrospective. See, for the purpose of 40A1A, where the 100% of disallowance was being paid for the purpose of TDS not deducted, it was ultimately restricted to 30%. And in the 30%, where the budget speech mentioned and the explanatory memorandum mentioned that it was to reduce the hardship. In such cases also, the courts have held that because it is to reduce the hardship, it should be treated as retrospective in nature. So the question now that arises will be whether this would be treated as a retrospective amendment. From assessment year 21-22, obviously the fresh application will be there. Now the employee's contribution would not be covered by the 43B. But what happens to the pending cases? So this we'll have to see, that the court has to decide whether this explanation, because it is for removal of doubts and it is specifically says that it is clarified that employee's contribution was never included in 43B, whether it will be treated as retrospective and it will affect all the pending litigations. According to me, all the pending litigations or 143(1), whichever adjustments have been done, we may have to continue with the litigations for another 3-4 years and see to it that whether this will be treated as retrospective. Though there are judgments where it says that removal of doubts, it is for removal of doubts or it's a clarificatory, it has been held, it is a retrospective in nature. But because those judgments were granting some benefit, those were in regard to benefit being granted to assessee. But in this case, a particular benefit available under section 43B on depositing delayed deposit of employees' contribution is taken away. In my view, still it should not be treated as retrospective, but only the time will come. So another round of litigations up to assessment year 2021 will remain, and it will continue to see whether this explanation will be treated as retrospective. A department may look into it as a retrospective. And the other way of thinking is because the explanation has been inserted today, assessee can argue also that before that this was never an understanding. Even the in fact amendment of explanation from AY 21-22 very specifically it says will apply from AY 21-22 and therefore it cannot be applied to previous assessment years. And that would be a better thought process. Another small amendments 43CA and 56(2)(10). Everybody knows it's only that in case of the residential plots where the stamp duty value has to be replaced by the builder. 43CA applies to stocking of trade, not 50C. And 56(2)(10) applies when I acquire an asset at the value less than the stamp value. It is treated as my income from other source. 43CA is from the perspective of the developer who sells the asset. The safe harbor limit was 10%, has been increased to 20% up to 30th June 2021. So this applies only to the real estate residential properties of a transaction between the from a developer to the home buyers. That's all. 44AB. It's for the professional. Excuse me. Section 44AB, exemption from audit. As you know, the tax audit limit under section 44AB was ₹1 crore, which was increased to 5 crores, and now it has been increased to 10 crores. The only, of course, this came in the finance bill. It has been discussed. It does not require much discussion on this forum, but there is a small amendment which has been made that this 10 crores limit was applicable only if their transactions not exceeding 5% were made in cash. So if my transactions of cash receipts and payments are exceeding 5% by way of cash, my limit would have actually gone down to 1 crore and not 10 crores. But now there is another amendment. If you read Finance Act, they have said that for the purpose of the receipt of payment other than account pay checks will be considered as a payment by cash. So it's a clarificatory according to me. So if there is no account pay checks being issued, and it's only a cross-bearer checks or self checks, it would be treated as if it's a receipts and payments by cash. And therefore, you have to also calculate, while calculating this 5%, those transactions wherein account pay checks have not been received, add those transactions, then compare it, then whether it's within the 5% limit of your turnover. If it is within 5% limit, still your limit applicable would be 10 crores. Otherwise, it would go back to 1 crore. Presumptive taxation as per section 44 ADA. Now, I don't know why this amendment has been made. Initially, 44 ADA was available to individuals and resident partnership firms and HUF also. What were not eligible was LLP, companies, AOP, boys. Now, HUF is also not eligible. So, all the persons, from the person there was an exclusion clause. Now only it is available to resident individuals and resident partnership. I believe that a lot of people are using an HUF structure for capital formations. There is no capital requirement, and people start the business with a proprietary concern owned by an HUF entity, HUF of a particular individual. And because no records to be maintained, no books of accounts to be maintained, and showing a turnover and just declaring 8%, 6% profit and paying a small tax, resulting into 2% or 2.5%, 3% tax. To discourage that, HUF has been removed from 44 ADA. So, coming to the assessment procedures, and before I go to the other important amendment, just to refresh, time limit of return filing and assessment has been changed. Now, filing of return of income under section 139(4), that is a belated return. The return for the assessment year 21-22, which was available up to 31st March 22, now has been reduced by 3 months to December 21. If you recollect, for assessment year, financial year, assessment year 2021, people who had not filed a return before 30th September or 31st January extended date, they had an opportunity to file under 139(4) up to 31st March 21. So you had a time up to be filed up to the end of the assessment year. Now from assessment year 21-22, that time is not available up to end of assessment year. AY 21-22 ends on March 22. So as per the revised provisions, it is 3 months prior to end of assessment. So once it is 3 months prior to assessment year, the due date for filing a return under 139(4) would be 31st December 2021. Similarly, if the return has been filed under 139(1) in July, September, October, whatever is your due date applicable, then it can be revised only 3 months prior to end of the assessment year. So the revision also is now latest available up to 31st December 2021. So the period of filing a belated return and revised return has been contracted. Now, similarly, there has been the revision in the change of time limit. As I mentioned earlier, the basic objective behind it seems, is to have a certainty of the transactions, certainty of the income assessment, and therefore the time reduction has to be done. It could be seen that the assessment year 17-18 and assessment year 18-19 are being assessed even today. So assessment year, when I talk of assessment year 17-18, last date was March 21. So in effect, there was a 3-year period where assessment was still going on, and which is now extended to April 21. So 3 years period. Overall, this time limit has now been reduced for passing an assessment order within 2 years period. If you see, like for 143(1), the notice also there is a reduction of time limit for issuing 143(1), so refunds can be processed faster from 1 year to the 9 months. So if the last date from the end of the assessment year 21-22, the last date of the assessment year is March 22. Now within 9 months, 143(1) has to be processed. So 31st December 22, you have a time limit. Initially, that time was available up to March 23. Similarly, the scrutiny notice time limit has been reduced from 6 months from end of the financial year in which the return is furnished to 3 months. So if I'm filing a return during the financial year 21-22, well, the scrutiny notice could have been issued up to 30th September 22. Now it would be available up to June 22. For your convenience sake, I've just tried to compile the various due dates which may be applicable for assessment year 18, 19, 19, 20, 2020. Obviously 18, 19 now already it's under the extended period, so it would not be applicable. But if you see the shaded portion, it's relevant for assessment year 21, 22. So the time limit between the end of the assessment year and the time limit between the completion of the assessment year has reduced enormously. So if for financial year 21 assessment, financial year 2021, March 21 is your end of the transactions and December 22 is last date of completing the assessment. So it is in nutshell 12 and 9, 21 months you get a certainty. So return the transactions of 31st March 21, which is over now the financial year. Return will be filed somewhere in October if you are under audit, and December would be the last date for revising. Intimation can be December 22. Even the assessment order can be December 22. So within 21 months time from the end of the financial year for which the transaction pertains, you get a certainty that whether any income addition has been made or not. So there's a substantial reduction in the time. There are small other amendments under 142.1. It's only jurisdictional assessing officer was empowered to issue notice under 142.1. Now it has been replaced with the prescribed income tax authority after the faceless assessment coming in. Another 143.1a. What does a 143.1a? 143.1a is regarding to intimation wherein the prima facie adjustments could have been done. 143.1a, the prima facie adjustments permitted under are given in columns in the paragraphs 1 to 6 over here, wherein there is certain amendment as far as point number 4 and point number 5 is concerned. What is this? If you really see, those point number 4 was in respect of adjustment could have been made on disallowance of expenditure indicated in audit report but not taken into account. So if there was a tax audit report which stated, like which they are doing it now, that you are mentioning a delay of employees PF, but you are not disallowing in the computation. So such adjustments could have been done in 143.1a, which has been done also. Similarly, if disallowance of deductions was mentioned in the return beyond the due date, if you have claimed some deductions and the return is furnished beyond the due date, then there was a power available in the 143.1a to do an adjustment. But this was both were in relation to deductions claimed and expenditure. Now, if you see, the 4 has been amended to increase in income indicated. So if there is an increase in income also, if your tax audit report says that there is an increase in income may be because, let's take an example, that 50, you have, as a tax auditor, nowadays we have to report the transaction value in case of transactions covered by 50C or 43CA, that if, what is the transaction value, what is stamp duty value. So there may be an increase in income. So if there is an increase in income indicated, whether those adjustments can be done under 143.1a, though those increases reputable, there may be some other increase in income. Initially, as per the existing provisions of 143.1a, any increase in income in the audit report was not, could not have been done, could not have been adjusted in the 143.1a order, which has now been amended to include that. I think so it's a welcome move, because ultimately the object behind 143.1a is to arrive at the correct computation of income. And if the increase in income has been indicated by the auditor himself, there was no point in taking that case for scrutiny and then increase the income and make a computation. It's better if it can be done through 143.1a. Because ultimately the auditor has pointed out that that effect should be given. Similarly, disallowance of deduction claim was restricted to certain sections, which has now been increased to all the sections of the Chapter 6. Any deductions in respect of certain incomes. So under the heading C, Chapter 6A heading, which are deductions in respect of income, income related deductions will be now covered under 143.1a adjustments. The most important changes which has been taken place, according to me, is the procedural changes as far as reopening of assessment is concerned. The way the reopening has been always disputed points, legal issues have been cropped up. What does the reason to believe means? What does the beyond 4 years means? What does furnishing of inaccurate particulars means? In what circumstances reopening can be? Whether audit objections can result into reopening? What is informations? What is application of mind? What is satisfaction? What is approval? So the reopening has led to a lot of litigations under the Act. There were a lot of interpretation issues. And ultimately, even today, after so many judgments of the Supreme Court, even today, according to me, if you want to argue whether the reopening notice was valid or not, you can have 100 sets, or you can have various sets of arguments. Various alternative arguments are possible, and if somehow the judiciary is on your side, you can get a benefit that the reopening cannot be resorted. There were all the concepts of change of opinion. All those concepts were there. I believe this procedure has totally been redone. I don't know why this has been redone. Obviously, I believe it has been redone because department, in its experience, would have felt that in most of the reopening cases, they lose on the legal and technical issue itself. Though they may have a good case on the merits, but the reopening itself is treated as invalid because of some procedural lacuna, some jurisdictional lacuna, or maybe something which the assessing officer has not been able to showcase while writing reason to believe or writing satisfaction by the higher authorities. And this has resulted into a lot of litigations, and department have lost those cases. So before reopening itself, what should be the precaution taken? According to me, this is a well proposed and not proposed, sorry, it's now an act. It's a very good move. A section 148 capital A has been instituted. Before that, please keep it in mind, section 147, 148 has been also completely substituted. Current sections have been deleted and the new subsections have been coming. Excuse me. So section 148 has been bring to it. I would like to cover this 148A before the amendments made in section 147 and 148, because 148 is a procedure, is a jurisdictional requirement which will come before issuance of notice under section 148. So 148 is a procedure which is must prerequisites before actually reopening. So there is a time gap. What does 148 says? Assessing officer, before issuing reassessment notice under 148, need to follow the following procedures under section 148 as follows. It may look like a procedure, but according to me, those are such an important, and there are adequate safeguards in this, which may result assessing officer into apply his mind at that moment of time. So there is no litigation later on. What happens is, as of today, a notice is issued, assessment is made, and ultimately, after 3 years or 4 years, it has been held that the notice is invalid. So, what does the 148A tries to do is, does all that procedure of application of mind, giving an opportunity, satisfaction, much prior to actually deciding whether the notice under 148 should be issued or not. So, what are the steps? There are sub-clauses provided under section 148. The first sub-clause says that conduct an inquiry. So before issuance of notice under section 148, assessing officer has to conduct an inquiry. Now this conduct an inquiry is also prior approval of specified authority. Specified authority has been defined under section 151. Just for a clarification, it's a commissioner and principal commissioner, a chief commissioner in certain cases up to 3 years and above 3 years. So he has to take a prior approval of specified authority, even for conducting an inquiry. So there is an advocate safeguard. If you see at all levels, there is a prior approval of specified authority. So the powers of the assessing officer are quite restricted in that way. He cannot also initiate an inquiry. This inquiry has to be with respect to information available with the assessing officer. So if there is an information available with the assessing officer, which actually may result, which may be in accordance with the information, what do we mean by information is defined under 148. And if that information falls in the 148, he needs to conduct an inquiry first with respect to those information. So he has to gather more information, look into the accounting records, understand actually whether there is an income chargeable to tax which has escaped assessment. So on those exercises, he needs to do it internally first. So what he will do is, what is expected from the assessing officer is, he has to map those information which is available with you, which suggest that income chargeable to tax has escaped assessment. So he has to map those information available with the assessing officer with probably the return of income which has been filed. And if it suggests that there is an income chargeable to tax as escape assessment, then he has to move off of it. So this inquiry will be initial. He will do an in-house inquiry. Up to this stage, he does not actually interacts with the assessing with the SSC. He only conducts an in-house inquiry and try to come to a suggestion, trying to come to a conclusion sort of that this information suggests of income escape assessment. Moving ahead, once he has come to a conclusion, yes, that this information suggests, he has to give an opportunity of being heard with the prior approval of the specified authority. So that information which suggests the opportunity of being heard has to be given. Obviously, if the opportunity of being heard has to be given to the SSC, the information which is available with him, it is expected that he has to share with that. Then only this would be within the principles of the natural justice. Giving an opportunity without sharing the information available, according to me, has no meaning. So he has to share those information. And this opportunity of being heard is also again with the prior approval of the specified authority. So obviously, whatever information which suggests will be placed before the specified authority. If the specified authority approves it, okay, it looks, yes, there is an income escape assessment, he may approve for the opportunity of being hearing given to the SSC. There is a time period given for ranging from minimum 7 days, but not more than exceeding 30 days for those opportunity to. After they reply on this opportunity, SSC has a power to reply it. Once this reply is received, after considering those reply and the information and material available on the record, he has to pass an order. This order again will be after the approval of specified authority. In my view, this order would be as good as the recording of reasons which has been done without considering, without giving any opportunity or without considering the assessor's reply. Now reasons are recorded internally by the assessing officer, and those directly a notice under section 148 has been issued. So hitherto onward, from the future onwards, now this procedure will be followed, and then the order passed. Obviously, this order has to be a detail. It has to give the details about the information, the suggestion drawn, or approvals undertaken, and after considering the assessor's reply, why the assessor's reply is not considered and still why the reopening has been resorted. So this safeguards looks to be quite severe. Before undergoing the harassment of the assessment proceedings under 148, a timely procedure has been followed, which looks to be quite good as of today. And the assessee gets time to reply on this. Obviously, this procedure would be also faceless. There would be a faceless opportunity, or except in the cases where the search or survey cases are there, but may be still continued on the physical basis. Now, there is a similar amendment in section 147 and 148. If you see, for the purpose of section 1, which is in regard to completion of reassessments, there were various provisions and explanations which have been deleted, and only the main section has been retained. Following conditions, only following conditions are required. Any income chargeable to tax has escape assessment for any assessment year, and assessing officer follows the provisions of section 148, 153. So for the purpose of section 147, it's very too limited. Section 148 is issue of notice for reassessment. What does it section 148 deals with? How the notice, of course, section 148 is again after following the procedure under section 148. Now, for the purpose of this, there is an under section 148 that what does it means by information has been explained. The information will include the following categories. In case other than search, survey, or equation, information shall be deemed to be suggesting that income chargeable to tax has escape assessment. A. Any information flagged accordance with the risk management strategy. Any final objection raised by the CAG. So that is a deeming as per this explanation. Any information received by the assessing officer shall be deemed to be suggesting that there is an income chargeable to tax, which has escape assessment, in case that information is flagged with the risk management strategy. Now, I don't know what this risk management strategy is. There is a risk management strategy. There is no permutations and combinations which a department does, and there is a like cash-based scrutinies are there. So there is a risk management strategy, but practically those risk management strategies, in some cases we have found the cases have been selected for scrutiny which are actually not required to be. Even if you see the high value transactions which are coming to it, those have been selected based on the risk management strategy. And in some cases, if you go really into those high value transactions or financial transactions, the value would be very limited. or it would not actually depict actually what it has been done. It may be a consolidated figure, it may be random figures. So I don't know what this information will be, but we'll have to see this information. The word information deeming provisions by way of risk management strategy, according to me, may open a plethora of litigations on this, whether this information actually falls with the risk management strategy, or because based on risk management strategy, once it is flagged, you cannot challenge it. It becomes a deeming provisions, becomes a derivative. But according to me, deeming provisions should be applied for the objective to which it is. So once it is a flag, that does not mean that that information itself suggests that there is an income chargeable to tax. Obviously, there may be an information, and therefore there is an advocate procedure under 148 capital A. Even after the information has been received under this particular explanation by way of flagging of transactions, he will have to inquire independently, give an opportunity, and then go. Similarly, a final objection raised by CAG. Now, CAG is an audit objection, that's what I can understand. There are so many judgments earlier also that only on the basis of an audit objection, a reopening cannot be resorted to. Assessing officer is expected to apply his independent mind to the information available. But now, once there is an audit objections, it would be deemed to be suggesting that income has escape assessment. Now, this deeming provisions has to be again tested in view of 148 capital A. It cannot be. So, if there is an information by audit objection, that means though the 148 may not be sacrosanct, but 48 capital A is sacrosanct. So there is an information deemed to be suggesting income chargeable. So the AO will have to resort to provisions of 148 capital A, do an inquiry further, take an objections from you, take your reply, and then pass an order. So at particular stage, he may, though there may be an initial flagging, there may be an audit objections. AO can actually look into my reply and pass an order requiring not to issue a notice under section 148. A second view may come. Isn't it there is a lot of power being given at this stage, or a discretion given at this stage, though there is an approval of the specified authority at this stage of deciding whether the 148 has to be issued or not. Initially, 148 notices were issued by assessing officer as soon as they were getting an information from BBIT wing, from an audit objections, and there was hardly any discretion available to those AO. Now there is a discretion available to conduct inquiry, consider reply, and then pass an order. Though there is a check by way of the approval, but there is a certain discretion which will be now available to assessing officer. It is not that he can issue under section 148. That may be also used in the benefit of the assessing, or maybe against also. 2. Another deeming provisions of that which will be treated as information for purpose of reopening is in case of such severe requisitions. Please keep it in mind that any search up to 31st March 21, there is a separate procedure of assessment prescribed under section 153 capital A and 153 capital C. 153 capital A is in respect of person who has been searched, and 153 C is in respect of any other person in respect of whom documents or any other valuable asset has been found. In case of third party search, then the proceedings under section 153 capital C are taken. From 31st March 21, after 31st March 21, that is today, if any search action has been taken place, the reopening of the assessment of those years will be done in accordance with the provisions of 148 and 148 capital A. Now, when I go to a 148 capital A, so this would be treated as a deeming provision. Information, as soon as search, survey, or requisition cases are concerned, it would be treated as information for the purpose of section 148. And therefore, the notice it will be issued under section 148 invariably. Of course, at the time of search, survey, or requisition, there should be an information, even at the search, survey, or requisition, there should be some information available which suggests that income chargeable tax has escape assessment in case of assessee for assessment. Please, it's very important to note over here. It's just not that 153A and 153C has been removed. It will change the total way in which the search and survey proceedings were being assessed. There are various judgments during the block assessment period, during 153A, 153C, when it was held that any assessment been made pursuant to a search under 153A, 153C, or that to 158BC, it has to be restricted to undisclosed income. You cannot tinker with the transactions which are reported in the books of accounts, and there is no material, there is no such material in that regard. But once this comes under the 148, now this is an information. Once the search has taken place and there is an information may be from the records, from the balance sheets available, that there is a missed claim of expenditure, not proper income declared, then also it will be treated as a deeming provision under the information. So, and it may not require that the undisclosed income should be found at the time of the search for the purpose of reopening under section 148. Assessing officers shall follow the process of 148 before issuing a notice under this. However, for search and requisition cases, the AO can directly issue the notice. So please, for 148A is only applicable in case there is an information available by way of flagging or by way of final objection raised by CAG or by any other method. So flagging and CAG objection is a deeming. It deems that there is an information. In other case, there has to be an actual information available to them. In case of search, survey or requisition cases, provisions of 148A, procedure or jurisdiction requirement of 148 capital A would not be followed. Assessing officer can directly issue a notice under section 148 capital A. That's an important point. So once the search takes place after 1st April 21, the assessing officer would be issuing a notice under section 148 for the period 3 to 10 years depending upon the claims. 148A, I have already discussed. Before issuing a notice under 148, AO shall conduct inquiries. Officer presence does not apply in search or requisition cases. However, in case of survey, the AO has to follow the procedure laid down in 148. So only exception is search cases. Section 149, time period for reopening of assessment. During budget speech, laying down the objective of certainty, it was said that the reopening period has been reduced from 3 years, from 6 years to 3 years. And only in serious tax evasion cases, it has been increased to 10 years. So in effect, there was an existing provisions where reopening can be resorted up to 4 years. Up to 4 years. If there was furnishing of inaccurate particulars by assessing, this 4 years could have been increased to 6 years. And in an exceptional cases, up to 16 years when there were case of foreign assets. So now all these differences have been removed. So 4 years is not there. Furnishing of inaccurate particulars is not there. It can go up to 6 years, and foreign assets is not there. Now there are only two limits. One is up to 3 years and from 3 to 10 years. In any particular case where the information is available which suggests escapement of income, it can be up to 3 years, reduced to 3 years. In case of serious tax evasion, what is serious tax evasion? AO is in possession of books of accounts or other documents or evidence which reveal that income chargeable to tax represented in the form of asset. Very important. It should be represented in the form of asset which has escaped assessment of 50 lakhs or more in a year. Then the limit applicable is 10 years after the approval of Chief Commissioner. Non-serious tax evasion requires an approval of Commissioner, but serious tax evasion requires the approval of the Chief Commissioner. So there are three conditions. Basically, it should be AO should be in possession of books of accounts or documents or evidence which reveal income chargeable to tax represented in the form of asset, has escape assessment, and that value of that asset is 50 lakhs or more in particular year. So it should be represented in the form of asset. There has to be books or documents or evidence which reveal that there is an undisclosed. If you read these wordings, and if you read the provisions available under section 153A, wherein also 2 years back, there was an amendment made, increasing up to, in a case of search, the years, 6 years, the assessee could go up to 6 years, and up to from 6 to 10 years, in case the income involved was more than 50 lakhs. And the wordings was similar, that AO should be in possession of books of accounts, documents, or evidence which reveal that income chargeable to tax represented in form of asset. Now, this form of asset is a very important thing. I think so, draftsman, legislature, in very strong case, he wants to actually tax only where the asset is available. Let's take an example. There is a document available beyond 3 years period of expenditure done out of the books. Expenditure. I have incurred a marriage expenditure of 50 lakh rupees, and the 3 years have elapsed. during the course of search, certain records have been found that the marriage expenditure was books or documents or loose slips were found, which says that expenditure for the marriage was 50 lakhs, whereas I have not recorded those expenditure in the books. The question that arises, whether this provision under section 149 allows me to go beyond 3 years because the expenditure or the amount of the tax escape assessment exceeds 50 lakhs. In my view, no, because whatever this income chargeable to tax should be represented in the form of the asset. There has to be an asset. If there is an undisclosed asset, if you find a loose slip wherein the property which you own today and that asset is there is a unaccounted money paid for acquiring that particular assets and some documentary proof is found, then obviously because that amounts are represented, that income is represented by way of asset, then only it can go beyond 3 years period. Not in cases where the income is not represented in assets, the income has been already spent up, according to which shall not go. The second issue which arises for a consideration and may be taken up by the assessees and may be argued that there are entries, transactions, loans, share capital, whether those are represented in form of the asset. If I receive a share premium or the share capital and the amounts that is a document available or evidence available, those were not genuine. But that share capital has been always spent by incurring losses in the company, and there is no assets represented in the form available today because there is already loss incurred. Let's take an example. I have received a share premium somewhere in assessment year 15-16, which is beyond 3 years. That's what 14-15 beyond 3 years. So whether this would be treated as represented in form asset, to my mind, no, because the share premium, though it was not ingenuine, there is an evidence that it should be taxed as income. But now, as of today, it is not represented in the form of asset, so that shouldn't be taxed. So one position argument can be taken, but only time will tell that how this would be argued. Even in the course of 153A, because this amendment has come in last 2 years, you will not find much judicial precedence on this, that what do you mean by when it talks of represented in the form of asset. Asset can be anything. It may not be necessarily a capital asset. It may be stock in trade. It may be current assets. It may be loans and advances. All those will be treated as asset. So though asset has been not defined, but according to me, all those will be treated as asset. So before going to this, now since a period has been extended from 3 years to 10 years, the question that arises, let's take an example for a certain years, for which the 6 years, the earlier provisions already time has been elapsed, whether they can be reopened in case of any books or documents being found, serious tax evasion cases, can they go beyond up to 10 years considering these provisions? And there is an advocate safeguard given in the provision in the section 149 itself, stating that the years for which the period has elapsed under the previous provisions of the law, they cannot be reopened. So let's take an example, assessment year 12, 13, 13, 14, 14, 15, wherein though there may be some income which now be found in represented in the form of asset, according to me, those cannot be opened because at the time of the search or at the time of unearthing those particular assets, already 6 years period which was ultimately available to them would not be there. Sanctioning authority for reopening. Section 151 provides that the specified authority for this purpose shall be, if 3 years or less have elapsed, then the principal commissioner. So if you compare it with the previously the period is 4 years and approval is required of joint commissioner. If AO is below the rank of joint commissioner, satisfaction of joint commissioner. And if beyond 4 years, the approval of the commissioner or chief commissioner was required. Now up to 3 years, directly commissioner. So directly the specified authority is commissioner. And beyond 3 years, it's chief commissioner. So obviously, the specified authority has been increased to the extent of the commissioners. There are more higher ups. I believe the more wisdom will come in. There won't be lock, stock, barrel approvals or reopening of the cases, which was been hitherto been done because there was only approval of joint commissioner required. And even joint commissioner came in up to 2015. Before 2015, if there was no 143 assessment was done, AO was itself empowered to issue notice under 148. So from time and again, I see that the approval authorities have been changed from AO to Joint Commissioner, from Joint Commissioner to now Commissioner in the regular cases, and even the Chief Commissioner beyond 3 years. So obviously, the more wisdom will come in. So I look at it that it should, the objective of the sections 148, 148A and the procedure which has come will be achieved. But definitely, it will be prone to a litigations, because whenever the new law comes, law is evolving. The words like informations, words like approval will be challenged, will be discussed at various judicial firms. The most important takeaway is, if I see from these amendments in the reopening procedures, the word satisfied has now been replaced by word approved. So the word, initially it was required as satisfaction of Joint Commissioner or the satisfaction of the Commissioner, depending upon 4 years or above 4 years. Now only approval is required. So a question may arise, an issue may arise, that whether the words, the satisfaction has been interpreted by various courts. Then what does mean by satisfaction? It has to be an objective satisfaction. It cannot be, it has to be a subjective satisfaction. It cannot be a mechanical satisfaction. You can just, initially, we have seen there are judgments wherein the satisfying authority has just mentioned, yes, I am satisfied. And courts have held, sorry, this is not satisfaction. Satisfaction means your application of mind is there. What is in your mind is written on that particular document while writing a satisfaction. The question will arise, what happens when this word gets changed from satisfied to approved? Approved is purely your approval, giving a signature, putting a signature, yes, I approve is enough, or even the approval means, it is obvious that approval means that there is a safeguard available. And the satisfaction, he has to go into documents, he has to see the note, he has to see that the provisions of section 148 and 147 are actually complied with. And it's a fit case for issuing a notice under 148, and then he should approve. According to me, the various judicial precedents which have been laid down while interpreting the word satisfaction would now be also applicable to approve. You cannot expect that there is a mechanical approval by the authorities such as Commissioner and Chief Commissioners. The authority, the reason behind specifying the authority at such a high level, highest level, I would say, if it's a Chief Commissioner, then the question is that they should apply the mind. Their application of mind should come on the paper. They should actually look into the documents. Those documents should be available to them. Now, all this process may be replaced. The question may arise, all this process may be replaced in an online manner, in a faceless manner. So how would this satisfaction and approval? We have seen that the approval as of today has been given in the system, words approved. So there is hardly any scope where the Commissioner actually records his findings on it. But according to me, if he's not doing that, he's not complying with the laws laid down by the various judicial precedents. So he will have to actually give in detailed satisfaction, objective, subjective satisfaction, and show that there is an application of mind before approving that. If it is not done that, obviously the assessor can challenge that there is no proper approval, and the approval is without application of mind, hence 148 proceedings are banned. So this is a comparison when notice, basis of comparison, existing procedure and amended procedure. Of course, we have discussed it, but if you see 140, when notice came under 140, AO has reason to believe that income has escaped assessment. AO has information which suggests the income. So the reason to believe has been replaced by information which suggests that income has escaped. So question is, when there is a reason to believe was that I have a reason and he has to document those reasons. Now the information is suggest that the income, suggest, of course, by dictionary meaning one can help that suggest does not requires it that it should actually result into a belief. A belief is much more in depth when compared to a suggestion. A suggestion may be a prima facie, but a belief has to be a very strong belief. It has to be a robust belief that there are income has escaped. So I think so, but still the time will tell how the judicial proceedings will come, how the information which suggests would be interpreted. Procedure before issuing a notice, record reasons to believe that the income. Now the procedure was AO only has to record the reasons, and if the satisfaction of the approving authority is required, then he has to take a satisfaction. Now this procedure has been replaced by procedure laid down in 148. It's quite elaborate procedure. It's a welcome move according to me. sanction authority for issuing notice as discussed. Comparison, it has been replaced from joint commissioner to commissioner minimum and from commissioner to CCIT. Time limit from 4 to 16 years has come down to 3 to 10 years. 4 to 6 and 16 years, I would say. 16 years was an exception circumstances, but generally 4 to 6 and this 3 to 10. Of course, in case of such, even today, there is a time limit of 6 years plus 4 years, 10 years, if the amount involved is more than 50 lakhs represented by assets. Now, this has been brought in over here and extended, so that which was available from 6 to 10 years window, now is available from 3 to 10 years window. Again, a basis of comparison, a very existing procedures, amended procedures, continue under the new provisions, which I have discussed in my brief. If you see, just to summarize it, for making it very easy, existing procedure says reason to believe. If it's more than 4 years, you require failure on the part of the assessee. There has to be failure, positive failure on part of assessee to furnish inaccurate particulars. If there is no, then you cannot go beyond 4 years. Courts have held that the reopening is invalid. Foreign assets should be, there should be some foreign assets involved, then only reopening was resorted to 6 years. Then there was continue, so according to me, this procedure, this 3 first in red will not be applicable now. Instead of that, amended procedure will be that information with AO suggesting that income chargeable to tax as escape assessment, prior approval of specified authority at various stages, at inquiry stages, granting personal hearing, at the time when the final order has been issued. Information flagged, final objection of CAG, inquiry under 148, conditions for extended time limit 3 to 10 years represented by assets, and third party in case of such satisfaction and prior approval. So these are the amended procedure. According to me, the remarks made in the green should still continue. The argument should be there. Change of opinion should not be, will not yet be permitted under the amended provisions, because the change of opinion, once the assessment has been done, change of opinion should be restricted under the provision of the 147 itself. Income escaping assessment will continue. Jurisdictional AO, yes, cannot reopen for verification purpose for making fishing roving inquiries. Recording of reasons in form of passing under 148A. So recording of reasons has been replaced by 148 order. Issues related to service of notice, approval of specified authorities, application of mind and procedure for assessment. So this will still continue. This objections, this all needs to comply. Income tax. Now, briefly, I have covered my more of my. I'll just brief up on 3 or other 4 important points which has been covered. As you know, all the settlement commission has been discontinued with effect 1st Feb 2022-1. So if there is a search proceedings, you don't have any leeway. You cannot go out. You have to go through the assessment proceedings only. It has been stopped. If any settlement commission is pending today, you have been given 3 months time to withdraw that application. If you don't withdraw, it will be considered as pending cases and will be decided by interim board of settlement. This interim board of settlement will function on a faceless basis. Please make a note. TDS amendments, it's under chart. I'm not covering it because I'm sure this have been covered in length. There are separate TDS charts have covered. Only thing which I would like to bring it out in short is, if there is no, now there is a penalty rate for not furnishing of PAN in case of TDS, which is as per act, as per rates in force, or 20%, whichever is higher. Similarly, if they are non-filer of income tax for last year or for 2 years, then you have to pay 2 times of the act or 2 times as per the rates in force of 5%, whichever is higher. And if you are not complying, if the deductor is not complying, both the provision, there is no PAN and is not filing the return, then the higher of whichever will apply. So this is what I would say applicability of section 206AA and AB applies to TDS provisions, whereas 206CC and CCA applies to TCS provisions. It's a similar, it's a penalty rate in absence of PAN and TCS. I'll just like to point out one important point which has come. 194Q, TDS on payment of certain sum for purchase of goods from residents. So now if you are purchasing any goods from resident, you also have to deduct 0.1%. This will be applicable from 1st July 2021. This is in addition to where the seller is already collecting tax on goods sold under subsection 1H of section 206C. So there is exception given to other clauses of 206C, but not to subclause 1H, which implies that the seller will also collect 0.1% and the buyer will also collect 0.1% if the transaction is between them. So it's a double. So they are increasing the mechanism. And if there is no PAN, then that, of course, obviously this again is applicable to the, if the value of the goods involved is more than 50 lakhs. So it applies to the major. There was a speech from the finance minister in between that it will not affect the small businessmen. 234F fee, late fee reduced from 10,000 to 5,000. Another amendment made in Act, limit has increased. Bill had proposed 2,50,000. Any interest earned on contribution made by the employees in excess of rupees 2,50,000 was proposed to be taxed. Any interest earned on those contribution. Now it has been increased to 5 lakhs, but subject to a condition wherein that employer is not contributing. So if employer is not contributing any amount, you get a limit of 5 lakhs. If employer is contributing, then you get still a limit of 2,50,000 only. Any amount contributed over and above, interest proportionate to that amount would be taxable now. So this is a chart. Other amendments, small, liable to tax itself is a big, which can be discussed. It may take a line. Liable to tax has been defined under the Act. You need to look into section 6 bracket 1A, which was amended in last year, which said that if a citizen of India is not a resident of any other country, because he's not liable to tax in any other country, and his income is more than 15 lakhs from India, then he would be treated as resident in India for the purpose of tax. So the question arises, what do you mean by liable to tax? Section has been, the 229A has been inserted to define liable to tax, means in relation to a person and with reference to a country, means that there is an income tax liability on such person under the law of that country for time being enforced, and shall include a person who has subsequently been exempted from such liability under the law of that country. So if the person is liable under the particular country and has an income tax liability, then he will be treated as liable to tax. So if he is not liable to tax over there, then only he will be considered in India. So then there are specific provisions which are not covered for ILFS 47 transactions 1010D and 72A. This is 47 amendment is specifically with in relation to Indian Infrastructure Finance Company to be incorporated now, and 72 is a carry forward loss in case of amalgamations of PSUs. Important point, one more, 234C has been amended. Now dividend income will not to be considered for purpose of calculating interest, because dividend mere control mein nahi hai. I have no control of the company who will be granting dividend when. So I cannot pay advance tax and estimate dividend income. So there won't be interest when it includes dividend income. Initially, it was available to capital gains only. Last 281B provisional attachment has been amended to include any imposition of penalty under 271AAD. 271AAD bills is a penalty, 100% penalty in regard to fake invoices being recorded in books of accounts. So these are bogus bills. So if there is a penalty imposed at 100% of the fake bill or fake invoices recorded in the books of accounts, and that amount is about 2 crores, a provisional attachment can be resorted under 281B. 245MA dispute resolution scheme is going to be coming, but the disputed income only for a small taxpayers whose total income is less than 50 lakhs. And disputed income involved is not then more than 10 lakhs, then only. 89A, taxation in income from the retirement benefit account. The person having a retirement benefit account, non-resident at the time when he was employed abroad, and that benefit account continues, then he comes to India. So there is a withdrawal from retirement benefit will not be taxed. That's a double taxation relief has been given. Thank you very much. So I have tried to cover the major amendments and also tried to bring in my presentation all the other small amendments, though I could not cover in the length, but all important amendments where the time will tell how the courts decide or what would be the litigations involved. I have tried to cover that. So thank you very much. Thank you very much. Thank you for your patience, and we can take questions, Krishna ji.
Yeah, thank you, Piyush ji. Now I request our core group member, CA Manish Dedia ji, to share his screen so that we can take the question answer. Hello.
Yes.
Now I request CA Manish Dedia ji to share his screen for the question answer.
So I will read the question and Piyush ji can reply.
Yes, sir.
Okay. So the first one is, in case of partnership firm assessable under 44AD, then also capital gain in the hands of firm is applicable, since in this case firm is not liable to maintain books of accounts.
Yes, it should be applicable. The question is, how will you calculate the capital account balance? And
Correct.
whether they can insist that for the purpose of reduction of capital account balance as on 31st March, an argument can be made because the machinery provisions fail, the computation itself fails, so that can't be a capital gain, and 45(4) should not be applicable. But there is no exception to it. So only argument available to you would be that machinery provisions are failing because there is no books of accounts and the capital account balance cannot be calculated.
So what is the advice actually? Whether we should pay the capital gain tax, means firm should pay the capital gain tax, or whether
According to me, we can argue that the machinery provision fails in 44A.
okay, thank you.
The second one is, if company is having financial crisis and also not paid salary, then what is the position for employee contribution? This I believe is in relation to
It
PS.
does not change. It would be disallowed now onwards, 43B.
For service the third question would be, the for service company that is software development company registered in India having turnover about 3 crores, if criteria of 5% receipt and payment is satisfied, then tax audit is not applicable. Please confirm.
According to software, no, I think the limit would be 10 because software development does not comes under profession.
Ajay. So basically 5 crores limit will apply.
5 and 10, whatever it is.
5 and 10, yeah.
This tax audit is not applicable in this case.
Yes.
Yeah. So the fourth question is, if it is difficult to know other than the account we check, and we put already a disclaimer in our tax audit, then how to assess whether tax audit is applicable or not?
A very nice question. For deciding an applicability, how will you decide? According to me, we should take a representation from the assessee. Assessee will state that no, everything is an account pay check, and based on that, you can take a call on tax audit, and that is also a reasonable ground for not imposing a penalty under 271 capital. But a very nice question.
The fifth question is whether jurisdictional AO can issue notice under 133(6) to assessee for faceless assessment.
Yes.
Where it comes, it is normal thing.
Yes.
Anyway,
but yes, and they have been issued. They are been issued also, and they can also.
They can for collection of information. Okay. The sixth question is, what is the time limit to complete the assessment for AY 18-19?
It has been extended up to 30th April 19.
The seventh is, order under 143(3) for assessment year 18-19 was 31st March 21. Whether the date has been extended as in our...
Yes, all assessments which are due on March 21 are extended up to 30th April.
The time limit of intimation and scrutiny for 18-19 and 19-20.
I have given in a chart. If I will be sharing that chart, if somebody can refer for 18-19, 19-20, 20-21. And we need to calculate that.
Okay. The ninth question, whether in 143(1)(a) will be made when assessee has not taken into income because of either being following cash system of accounting, say in case of a lawyer, or when lawyer does not consider income of the amount received as advance and shows in the balance sheet as advance from client from whom the service are still
very pertinent question. Very pertinent question. After amendment made in 143(1)(a), obviously now the adjustments can be made towards income also. Now this income says, but if you leave the amendment is in respect of income reported in audit report. So obviously such amounts will not arise in audit report. So there may not be an occasion to do a 143(1)(a). Only if they go on a 26 years basis, what is the income in 26 years, whereas I am following a cash basis, and they do a 143(1)(a) adjustment, which is not permissible according to me. So according to me, it cannot be done.
The next question is, will reason or approval of a prescribed authority for reopening made available? Will reason or approval of prescribed authority for reopening made available to the assessor?
Yes, yes, yes. It's our right. We can get it.
Yeah. Is it feasible for assessee to verify compliance with internal inquiries and obtaining prior approval under 148?
Yes, same to 10. Same to 10.
Yes. Yeah. Can assessing officer non-resident ward asked to file income tax return under 148 though return already filed as resident for the previous year?
can AO non-resident ward asked to file income tax return under 148, though return already filed as a return resident for that previous year? No, he cannot say you file under non-resident ward. Sorry, he cannot. Okay,
Actually,
I will file for that particular year. I will file another return in response to 148 as a resident if I am a resident. Question is non-resident. What is asking? Because probably your jurisdiction now you are a non-resident, and during that year you may not be a non-resident. Therefore, your jurisdiction would have changed. So he's asking you to file a return. You will file as a resident. Why as a non-resident?
so we have to reply like we have filed it as a resident.
Yes, I remain a resident, and I will refile it as a resident.
Yeah, for that previous year means it is related to 14-15 previous year.
Yes, yes. If I am a resident, I will remain a resident, though I have become a non-resident today. So it's for that particular previous year assessment year. I am a resident. I'll file as a resident.
Resident. Okay.
Assessee, the next question will be the assessee paid full set of assessment 14-15,
Yes.
but
He is debarred. He is debarred. There's a specific provision that now he cannot go beyond other provisions.
Right. Whether the next question is whether 3-year rule to issue notice is prospective apply only for which AY.
See, there are two. This is a very big issue which has been deliberated. The question is, the law applies to the assessment year. So according to me, law applies from assessment year 2021. Assessment year 21-22, sorry, 1st April 20 onwards. If you see the amendment which has been made is applicable from 21-22, and there is a Supreme Court judgment, a 60 ITR, I don't know, Kerala, in case of some Kerala High Court judgment was Supreme Court, and the latest judgment of Shri Chaudhary Transports, Supreme Court, which says that law which is changed is applicable from the assessment year. So all the provisions would be applicable from the assessment year itself, and therefore it should, the old assessment years will still fall under the old rule. So 3-year rule should not apply. Let's take an example of assessment year 16-17. A question arises whether these within 6 years, whether those can be opened. It can be opened according to me, but there are divergent views. Please keep it in mind. One view says because this is a procedural matter, and once this is a procedural matter, it will be applicable from the date when the procedure comes into the play. So according to me, if it has been reopened, we should challenge and take an objection on day one itself. But the Supreme Court judgment says that the law will be as applicable to that assessment year. Yes, please.
Okay. The next question, the issue of notice more than 3 previous year has been extended till 30th 4. Yeah, then I believe that notification is there.
Yes, yes.
And the third one, the last question, any thought on controversy under section 194 LD?
No, 194 LD is on. There's no amendment, I believe, on LD. No, it's clear. Have I missed something? I'll get back on this 194 LD. There were, I think so, Krishnaji, Simaji, there were 2 queries which you had sent me earlier. I'll try to address on that. Okay. One is in regard to the notices been issued without following on 31st March, without following the procedure of 148 capital A. What happens to that? As I had responded to earlier query also, the law as applicable to assessment year should be there. There is the judgment which I was referring to is Karimurtri T 60 ITR 262, and there is one Shri Chaudhary Transport Company, Supreme Court, wherein 40A1A amendment which was made in October 2004 and made applicable from financial year 4-5. Because there were, if you remember, in 2004, there were budget was in September month, and there were 2 financial started for financial year 4-5. But the Supreme Court said 40A1A will apply for the whole financial year 4-5. Though the budget came itself on 10 September 2004, and I didn't knew. So Supreme Court said that it is applicable for whole of assessment year 5-6, whole of assessment year 4-5, because it is law applicable to assessment year. There is a divergent view. There is a strong divergent view that the procedural requirement should be applied today. Now, an assessing officer may always argue that the act became applicable from 28 March 2021. 148 has been brought in statute from assessment year 21. financial year 2021. How would I know up to 28 March 2021 that I have to follow first 48 March? It's because there are some notices issued before 28 March also. Only objection which you can take is after 28 March, that whether the new procedure be followed. But to my mind, objection should be taken, kept on record, but only time will tell whether this procedural provisions will be taken into consideration, that no extended period or the new procedure would be applicable for all the previous years also. But as of law, the law says that the law as applicable to assessment year will be applicable. Thank you very much.
Thank you, Piyush ji, for such a nice and informative presentation on Finance Act 2021. You had covered the major sections and subsections in greater details by giving practical examples. I hope the current financial year will bring the happiness in your profession. Now I request our Deputy Convener, C. Jayesh Thakkar ji, to give a formal vote of thanks to the speaker. Jayesh Thakkar ji.
Yeah. Thank you, Convener Sir C. Krishna Kumar ji, for giving me this opportunity to propose our heartily vote of thanks to our today's speaker, CA Piyush Chhajed ji, on the topic of analysis of the Finance Act 2021. By looking at his command on this subject and the very enthusiastic speech, and he has made us aware that the scenario, it is going to change after the introduction of the e-assessment, etc. He has covered all the important provisions in a very detailed manner, in a lucid manner, and his presentation was very detailed cover and very informative. So I hope all the members are benefited with his views. On behalf of our JB Nagar CPA Study Circle, I propose very heartily vote of thanks for spending his valuable time with all of us. I also thank all the core group members for attending our annual general meeting today. And I thank all the members for their patient hearing. So I think with all your permission, we may conclude this session for the day.
Yeah, thank you. Thanks a lot.
Thank you, Piyush ji, for the nice presentation.
Thank you,
Thanks
Simanju.
a lot.
Thank you, Krishna.